Hey guys, today is Sunday, November 30th, and we are getting ready for the opening of a new trading week. The market is currently in a very interesting phase of uncertainty where most participants are confused about the direction. However, the charts and on-chain data are giving us very concrete clues. Today, we're going to analyze the current situation comprehensively. We'll look at the higher time frames, assess crowd sentiment, and of course, peek into the liquidation maps to see where the market maker has hidden the money. Let's kick off our analysis with the 12-hour Bitcoin time frame to see the global picture. Right now, the price is trading around $91,383. The first thing that jumps out at you when looking at the price structure is a clear fading of the bullish momentum. Notice this graphic element, the orange arc, which I've marked as the liquidity trend. This arc visualizes a pocket of descending liquidity and shows how the market is losing strength. Every new local high is harder for the price to achieve, and we are literally rolling down a parabolic trajectory. On the chart, you can clearly see the red crosses marking sequential lower highs. This is a classic structure of weakness. The buyer can no longer update the high, and the initiative is shifting to the seller. We see a series of red and blue candles forming a descending structure right under this orange arc. Also pay attention to the EMA indicator, the exponential moving averages. The price is currently tangled in this ribbon, testing it from the bottom up, which often acts as dynamic resistance. However, within this bearish picture, there is a nuance. Look at the white horizontal levels on the right. The nearest significant resistance level is at $93,938. Just above that is $95,849. My scenario is that the current price slide cannot continue forever without a corrective bounce. The market loves to shake out early shorters. Therefore, looking at this rounding trend and resistance levels, I anticipate that before we see a full-blown move to the correction target area of $85,000, the price will make a sharp jerk upward towards that white line at $93,900 to test the broken structure and collect the stop losses of those currently aggressively shorting this curve. This fits perfectly into the logic of a liquidity grab before the main move down. Now let's look at what's going on in the heads of market participants. Here is the Fear and Greed Index. The index value has dropped to 29. This is the fear zone. Let's think about these numbers. Bitcoin is trading above $91,000. These are historic highs. We are literally one step away from absolute records. But the crowd is scared. Usually when the price is this high, we see values of 75, 80, or even 90 extreme greed. But right now, with the price over 90,000, people are afraid to buy. On the chart below, where the white line is the Bitcoin price and the colored histogram is the index change, you can see how sentiment has sharply dropped. The colored zone went down, while the price, the white line, is still holding quite high. This divergence, the gap between high price and low sentiment, is a bullish signal in the short term. When the crowd is afraid, it is profitable for the market maker to push the price up as resistance from sellers weakens. Those who wanted to sell out of fear have already sold. This creates the ideal soul for that squeeze upwards above $93,000 that we discussed on the previous chart. The market needs to punish the fearful bears, drive them back into buying at the highs, and only then reverse. Moving on, let's look at the behavior of smart money through the spot Bitcoin ETF statistics. Here we have the table with daily net capital inflows. Look at the latest data for November 28. We see a positive net inflow of $71,370,000. This is a green number, and it is very important in the context of previous days. If you look at the line below for November 25th, a massive outflow was recorded, minus $438 million. That was a moment of local capitulation and profit-taking by institutions. However, the panic did not continue. By November 26th, we saw a small plus of 21 million, and on the 28th, already over $71 million. On the chart to the left, where trading volumes and fund flows are shown in green and red bars, you can see that after a series of red bars, outflows, green ones are starting to appear again. The total net asset volume stands at an impressive $119,390 million. What does this tell us? Big capital has stopped aggressively dumping positions. They are starting to carefully buy the dip. These aren't insane billion-dollar purchases like during the rally, but it is stabilization. This is another argument that we won't drop like a stone right now. Institutions are supporting the price, which gives us fuel for local growth and a test of the upper range boundaries. Now let's move to the most interesting part, the blood of the market. Let's look at the heat map and liquidation statistics from CoinGlass for the last 24 hours. On the left, we see a huge red square labeled BTC with a figure of $2,059,000. These are just liquidations in the moment on one cluster, but much more important is the table on the right, total liquidations. In the last 24 hours, $125,800,000 were shaved off the market. Let's break down this figure. Of the $125 million, $86,060,000 came from long positions, and only $39,740,000 from shorts. This is a skew of more than double. This means that over the last day, the market has already punished the overly optimistic bulls. The local fuel for a drop is temporarily exhausted since the longs have already been liquidated. Usually when the market shaves one side, in this case the longs, the pendulum swings the other way to shave the shorts. Considering that few shorts were liquidated, their positions are accumulating now and they feel safe. This is an ideal target for the market maker, to go up and collect liquidity from profitable shorts. Here is the histogram showing leverage clusters. The current price is marked by a dotted line at the $91,322 level. Pay attention to the right side of the chart. We see massive yellow and orange bars shooting upwards. These are cumulative short liquidation levels. The clusters in the range of $92,000 to $94,000 stand out in particular. These tall orange skyscrapers represent pending buy orders, stop losses of shorters and liquidation prices. At the same time, on the left, below the current price, long liquidation volumes look more scattered and less concentrated in the moment, as we just dropped and have already cleared some of them. The market always seeks the zone of highest liquidity, like a magnet. Right now, that magnet is above. The tastiest range for the price is a move above $92,500 up to $94,000. This is mathematical confirmation of why we should see growth before the fall. We simply must take this money. Let's detail this picture using the liquidation heat map, which gives us an even more precise visual representation. On the dark purple background, we see bright horizontal lines. The color matters. The closer the yellow, the more liquidity is concentrated there. Look at the bright yellow strip running right above the current price. It starts roughly at $92,000 and becomes brightest and densest towards $93,000. This is literally a wall of money. We also see liquidity below, a bright yellow strip around $89,000 to $90,000. The price is currently squeezed between these two zones. But considering what we saw on the fear index and the long liquidation data, the path upwards seems to be the path of least resistance at this moment. The scenario here reads clearly: first to squeeze up, piercing this bright yellow zone at $93,000 to activate all these orders, and only after this strip fades, meaning liquidity is taken, a reversal toward the lower yellow strip at $89,000 and below to our global target of $85,000. And finally, the final chord, the 4-hour chart, where we bring everything together into a single trading idea. Here we see a more detailed structure. The price is in a descending channel, but there are signs of a reversal. Pay attention to the RSI indicator at the bottom of the screen. The bright green text labeled Bull signals to us that despite the price updating local lows, the strength indicator is not dropping that low. This is a powerful signal of hidden buyer strength. On the price chart itself, we see highlighted zones. These are imbalance zones. The nearest significant 4-hour fair value gap is sitting right above the current price, covering the range of $92,000 to $93,000. Also note the horizontal white level lines. The first target is $91,291. The next is $93,938. On the left, we see the volume profile. The main trading volume shelf, the point of control, is higher and the price has sort of dived under it. My scenario based on this chart and all previous data, we bounce from the current support, play out the bullish divergence signal on the RSI, go up to close the 4-hour imbalance and collect liquidity beyond the 93,000 level. We might even touch 95,000 with a candle wick. That will be the liquidity grab. As soon as we see this throw upwards and a sharp reaction from the seller, a long wick on top, that will be the signal to open short position with a target of 85,000, where the next global zone of interest lies. So the plan is local long to 93 to 94,000, and from there, global short targeting new lows. That's all for me. The market is giving us an opportunity to earn in both directions if we act cool-headedly and stick to the facts. Good luck to everyone and control your risks.